Hi, everyone. Just checking in from Aruba. As you can see, look at my background. This is paradise. I haven't been here in many years, but finally was able to come here with my wife. Just truly, you know, appreciative. Just truly blessed to be here. This is such an amazing time, and so I'm here with Tay today, and we're here to really just educate you on different topics. One topic of particular interest that really, we want to share more about is the investment structures, fund versus syndication, and there's pros and cons to both of them, and we want to try to break away the confusion that investors may have regarding the fund versus syndication. And Tay, tell us what you know about this subject.
Oh yeah, sure. Yeah, thank you, Adam. Yeah, I wish I was there with you too. By the way, yeah, in a syndication deal, the sponsor is going to go out and raise money from a pool of investors to purchase one, or it could be like more identified properties at identified pricing and identified management terms. So as you can see here, the operative word is identified. So in other words, it's not blind, meaning you as the investor know exactly what you're getting, and that's what you're signing on for. So the advantage of syndication right there, you can underwrite not only the sponsor, but the assets to be acquired as well. And you can usually view the historical financial of the asset, the renovation plan and budget, and future projection before you reach the decision to invest. So in a way, you are in a position to pick and choose which asset classes to invest in, which properties to invest in, and even which markets to invest in, simply by selecting a syndication that fits your preferences. On the other hand, the downside is that you get less diversification unless the syndication is acquiring multiple assets located in different areas. The moving on to real estate private equity fund is also pooled vehicle, but it's more trust-based vehicle compared to syndication, calling for investor trust and the vision, reputation, and track record of the fund sponsor. In contrast to the syndication, a fund is mostly designed to acquire multiple assets in the future. Uh, Funds can be set up as a blind pool where you give the sponsor complete discretion about which assets to buy, or they can be set up as a semi-blind pool where you give the sponsor latitude to buy properties as long as their buying criteria meet your predetermined criteria. Like for example, like apartment complexes between 50 and 100 units built after 1990s in Austin, Texas. The advantage of funds is that you get diversification because the fund by nature is buying multiple properties, perhaps even in different areas. The disadvantage, however, is that you don't get to see the properties prior to making your investment for the most part. You are completely relying on sponsor to make all the decisions on what to buy. And if they buy a property that you don't like, then you're pretty much stuck with it. So the other advantage could be that you cannot underwrite the assets or see the financial or the projections of specific property before you make your investments. So yeah, this is my overview on funds and syndication. So Adam, is there anything else you'd like to add to this?
Yeah, absolutely. So um, that's it. Thank you. You really touched on the subject and really gave a great explanation. Funds or syndications could be debt or equity. So it doesn't have to be just an equity syndication. There's a lot of syndicated debt as well. In fact, Daniel Edry with TCS, his family company, B Corp Capital Markets, it was a lot of their family capital where they were going out, syndicating, pulling money together to make a loan. And generally, the reason why you do that is because your capital is limited. Or you could do a fund, or you could open up a fund where you're basically going out looking for borrowers to make loans, and then you pull then you have almost like it's a mortgage pool basically, where you have pool mortgages. Everybody has ownership. Same thing with an equity fund too. You could go out or you go out and find property to buy and constantly buy, sell, or buy, build, sell. So there's different types of risk and asset classes. But we like I said, we just want to focus on basically the fund versus syndication. And really, another important thing to know is that there could also be different types of terms, where what's interesting that's happening is that Tei and I are seeing is that there could be liquidity as well, where basically with a fund, since there's different investors that are coming in at different times, so everybody could have their own start and end date, meaning that you may have a start date, let's say it's today, and end date is 5 years from now. However, you can have an early redemption within 2 years, 3, maybe sooner. We're actually looking at deals now with a sponsor where they have an early redemption within a year, or all you gotta do is give a what do you call a 90-day notice. And the reason why is because there could be multiple capital events where they're either selling property that creates liquidity, or they have investors that come in, replace the investor with a new investor, and which is completely fine, you know. So that's different structures, and with technology, there's secondary markets opening up, which we could touch on. You know, one key factor though I always want to stress, and I know I stress this with Tei, is that, you know, granted, I know investors are studying syndications, they're studying funds. That's great. However, really, I cannot stress enough, study the sponsor, because you can look at projections, the asset class, the return metrics, all of that. But really, you know, a good sponsor could turn a good deal, or I mean, a bad deal could be the hero in a bad deal. And a bad sponsor could ruin a great deal, which is true. And when you're really focused on the sponsor, really focused on vetting, actually created a blueprint to kind of give you an overview, and then Tei and I will add more to the blueprint later on. You know, it's a good start for vetting sponsors. Another important metric is with a fund is that what I like about it, or what Tei likes about it, is that you're constantly adding more properties to the portfolio, which adds more security, where now you're adding more additional layers of assets that really dilutes your risk. And by doing that, you know, you could like, let's say you have one property that isn't performing well. Well, the other ones will perform better, where it kind of helps lessen the damage of a bad performing asset, let's put it that way. Another factor is funds are another good structure, because they could be evergreen funds, meaning that the manager is constantly adding and selling, adding, building, or selling. And what's really nice is that you know, they're not forced to you know, it could be a 5-year minimum hold for investors, but, you know, let's say they can't sell a property, it doesn't make sense. Well, guess what? They'll hold it, and they're going to have cash flow, and they'll have cash flow from other assets, and then they could sell one. Maybe they sell one for a loss, but guess what? We're okay, because the other ones are performing better. You know, so really it dilutes our concentration risk. Like, if you buy one asset in a syndication, you're one black swan event like this pandemic could blow up your whole investment. And a fund, you know, you'll have maybe hopefully not, but if you have a few bad apples in there, you know, the other ones will perform better. And that's really it, you know, a fund versus syndication. I really cannot think of any more things right now. Minimum investments, you know, it really depends upon the sponsor. For us, we look for sponsors that have a higher minimum investment. We look for sponsors that are more institutional quality, meaning they do have institutional capital partners. They have a higher minimum investment. So we're trying to basically invest with that sponsor, and we want to make a deal with them where we could basically bring in the smaller investors that they don't want to deal with, and we also had education with it. And Tay, you want to add anything? Am I missing anything?
Yeah, I mean, you really like summarize all the aspects of fund and syndication, I think. Yeah. So, I mean, but then I know we both agree that whether we should invest in a syndication fund is a really tough decision to make, right? But from what we discussed, you can see that they are quite similar in many ways. Both can be great vehicle to create passive income through real estate. But as Adam mentioned, like the bottom line is whichever you choose to do first, the most important thing by far is your due diligence. It's imperative to learn how to properly vet sponsor and properties. Learning how to do these things takes time and experience. So obviously, the more you do, the better you get. So we should ask ourselves how much risk we are willing to tolerate. So once that's all done, then hope is that investing in passive real estate opportunity will create a passive income stream that you're looking for. Yeah.
One more thing I forgot to mention. So one benefit of a fund is, for example, what we're doing with TCS or other investors is like opportunity comes, they raise millions of dollars, if not billions, and they have a war chest available to go buy distressed assets. They haven't identified them yet, maybe identified a few, but they know a lot are coming. So they want to build their war chest to go shopping. So what they do, they start a fund. It could be a blind pool or semi-blind, like you said. Semi-blind is you already know, okay, I know my asset class. I'm going after multifamily. I'm going after single family. I'm going after a value add with certain boxes. You're sticking to it. Blind pool is the manager has full discretion to do whatever they want. But that's really another benefit of a fund is like circumstances like this, a black swan event happens. You know, 2008, you have private equity firms that are just raising millions, if not billions of dollars, and they're looking for those bargains. They're looking for those deals. That's what we did for fund number 3. You know, it was an opportunity. They didn't want to raise the money quick and go shopping, you know, and that's what we did. So that's a perfect example of a semi-blind fund is that we already know the boxes that we're looking at. We already know everything, the asset class, the strategy, and you want to raise the money quick to go take advantage of short-term distress. But we're very bullish on long-term fundamentals. And, you know, we're benefiting from their ability to be able to find assets, you know, to take the risk off from us away, because finding due diligence is a lot of work. It's a lot of moving parts. They're doing all that for us, and yeah, it's we're very excited to see what we have in the future with fund number 3. You know, I'm very excited, and yeah, that's basically it. So anyway, again, thank you so much for listening to us. Tay, thank you for your time today. And
Yeah, of course. Yeah.
we're going to have another subject. Let us know what you want from us, any type of subjects, any type of, you know, if you want us to touch on more on this, if you go deeper, but this is just a broad overview. I don't want to get into too much technicals. I want to keep it very broad, very simple to understand. And until next time, happy investing. And thank you again for putting your trust in us. And, you know, we want to be able to just help. And that's really our mission, just to really help, seek, serve. So thank you very much.
Yeah. Take care.
Take care.